Welcome to the deep dive. Okay, let's unpack this. You know how sometimes you stumble upon a topic that seems a bit, well, dense. Well, today we're diving headfirst into one of those areas that's absolutely crucial for anyone involved in business or thinking about it, the world of partnership taxation. Our mission today is to give you the ultimate shortcut to being well-informed on this topic, cutting through the jargon and getting straight to the insights you need.
Exactly. Forget dry textbooks. We're going to explore what really matters when it comes to how partnerships and their owners handle their income and expenses, making it clear and understandable for you.
Right. We've got a fantastic set of sources today all about the fundamentals of partnership overview. We'll be extracting the most important nuggets of knowledge, helping you navigate the sometimes tricky waters of IRS Subchapter K rules.
Which is the part of the tax code that deals with partnerships.
Exactly. Understanding everything from how income flows through to partners to the nitty-gritty of calculating a partner's tax basis. So grab a cup of coffee because here's where it gets really interesting. So when we talk about a partnership in the tax sense, what's the first thing you need to know? Like the absolute bedrock concept.
Okay, the absolute first thing to grasp is that a partnership is a flow-through entity.
Flow through.
Right. And what that means is the partnership itself doesn't pay income tax. The income or loss, it just flows through to the individual partners.
All right. Here.
And they pay the tax on their share. So the income is only taxed once at the partner level.
So no double taxation like you might see with some corporations.
Exactly. That's a huge advantage. And this applies to, general partnerships, limited partnerships, and even most LLCs, limited liability companies. They're all generally under these Subchapter K rules.
Okay, so if the partnership isn't paying the tax, what's the deal with its tax return? Does it even file one?
Oh, absolutely. It has to file Form 1065. But think of it as an informational return.
Informational meaning?
Meaning it reports all the income, deductions, credits, etc., but it doesn't calculate a tax liability for the partnership itself.
Gotcha.
The really crucial parts are Schedules K and K1 that come with it. Schedule K summarizes everything for the partnership.
NK1.
Schedule K1 is what goes to each individual partner.
Yeah.
It shows your specific share, your distributive share of all those income and expense items.
Okay, so that K1 tells me what I need to report on my own tax return.
Precisely. And here's a really important point, something that often trips people up. You are liable for taxes on your distributive share shown on that K1, regardless of whether the partnership actually distributed that money to you in cash.
Wow. Okay, so I could owe taxes on income I haven't even, pocketed yet.
You absolutely could. That's a classic partnership tax head scratcher for new partners. Your tax liability is based on your share of the earnings, not necessarily the cash you received.
That is a crucial clarification. All right, so income flows through, potentially before the cash does. Now, our sources mention ordinary business income and separately stated items. What's the difference and why does it matter for us?
Great question. It matters a lot because different types of income or deductions can be treated differently on your personal tax return.
Okay.
So ordinary business income or loss, that's basically the net result from the partnership's main business activities. Sales minus regular operating expenses.
Like salaries, rent, that kind of stuff.
Exactly. That gets netted out into one number, more or less. But then you have separately stated items.
And those are?
These are specific types of income, gain, loss, deduction, or credit that don't get lumped into that ordinary income calculation. They have to be reported separately on the K1.
Why separate?
Because their tax treatment might depend on the partner's individual situation. Think about things like net rental real estate income, interest income, dividends, capital gains and losses.
Things that might have special tax rates or limitations.
Precisely. Also, things like Section 1231 gains or losses, that's from selling business property charitable contributions the partnership made, any Section 179 expense deduction.
Okay, that's the big immediate write-off for equipment, right?
Right. Also, investment interest expense, partners' health insurance premiums if they're treated as guaranteed payments, retirement plan contributions, even tax credits. The partnership reports them, but the partner claims them.
So all those flow through directly onto my Form 1040 via that K1.
That's the path, yes.
And speaking of those items, let's talk about guaranteed payments. That sounds like a specific type of income. What exactly are they? Are they like a salary for a partner?
That's a good way to think about them initially, but with a key tax twist. Guaranteed payments made to a partner for services rendered or for the use of their capital.
Okay.
But, and this is the crucial part, they're determined without regard to the partnership's income or the partner's profit-sharing ratio.
Ah, so it's a fixed amount, not a percentage of profits.
Exactly, like a salary or an interest payment, but specifically for a partner. And they have this dual tax treatment.
Dual treatment? How so?
Well, for the partnership, they're generally an allowable tax deduction when calculating its ordinary business income.
Okay, so it reduces the partnership's taxable income.
Right. But for the partner who receives them, they are taxable income.
Right.
Ordinary income, reported on their Schedule K-1.
Got it. Deductible for the partnership, taxable to the partner.
Yes. And they might also count towards the partner's net earnings from self-employment, which impacts self-employment taxes.
Hmm.
Oh, and one more important detail. Guaranteed payments for services generally do not count as qualified business income, or QBI, for that Section 199A deduction.
Ah, okay. That 20% deduction we hear about. So guaranteed payments don't qualify for that. Good to know.
Right. It's a common point of confusion.
Let's put this into practice with an example. Our source gives us the Acme partnership. Can you walk us through how their numbers shake out into ordinary business income versus separately stated items? Just the flow, not every single number.
Absolutely. Acme is a great illustration. So they had gross business income, let's say $250,000, and some dividend income, maybe $8,000.
Okay.
On the expense side, regular salaries for employees, $50K, rent, $15K, depreciation, $10K, and importantly, guaranteed payments to partners, $35K. Plus a Section 179 deduction, $30K, and charitable contributions, $20K.
Right, a mix of items.
So to get the ordinary business income, we take the $250K gross income, subtract the regular salaries, rent, depreciation.
Makes sense.
But here's the slightly tricky part. You actually add back the guaranteed payments deduction here for the partnership's OBI calculation on the form, even though it's ultimately deductible. It sounds counterintuitive, but it's how the form works to isolate the ordinary operations. So after those adjustments, Acme's ordinary business income ends up being $140,000.
Okay, so that 140K is the main operational profit number flowing through?
Correct. Then, the separately stated items are all those other things we listed. The $8,000 dividend income, the $30,000 Section 179 deduction, the $20,000 charitable contributions, and importantly, those $35,000 in guaranteed payments also get reported separately on the K-1s to the partners who receive them.
I see. So the guaranteed payments are kind of deducted to get the partnership's bottom line, but then also reported separately to the partner as their income.
Exactly. This example really clarifies how things get sorted before hitting that K-1.
Beyond regular operations, partnerships often have initial costs. What about things like setting up the business? You know, legal fees, filing stuff.
Good question. Those are organizational expenditures and startup costs. There's a rule allowing partnerships to elect to deduct up to $5,000 of each type of cost in the year the business begins.
Up to $5,000 each. Okay.
Yeah, but there's a catch. That $5,000 first-year deduction gets reduced, dollar for dollar, if your total costs in either category exceed $50,000.
Ah, phase out.
Right. And any costs not deducted in that first year, either because they exceeded the limit or because you didn't take the initial deduction, get amortized.
Amortized. Spread out over time.
Exactly. Spread out and deducted over 180 months, usually starting when the business becomes active.
Okay. So examples of organizational costs would be like lawyer fees for the partnership agreement.
Yes. Legal fees, accounting services for setting up, state filing fees.
Yeah.
And startup costs are things like employee training before opening, advertising for the opening, market research.
Got it. But you mentioned a type of cost that isn't deductible.
Right. Syndication costs. These are the costs of issuing and marketing partnership interests, like printing offering documents to find investors. Those are generally not deductible or amortizable.
Okay, good distinction. And just to circle back quickly, you mentioned the Section 199A QBI deduction earlier.
Yes, briefly. Just to reiterate, as a partner, you might be eligible for that deduction, potentially 20% of the qualified business income that flows through to you from the partnership or LLC. It's a below-the-line deduction, meaning it reduces your overall taxable income.
Which can be pretty significant tax savings.
It absolutely can be, yeah.
Now let's get really practical. Our source gives us this fantastic peek into a CPA named Carlos, preparing a return and hitting some snags. Diagnostic issues. This is where we see the rules hit the road, right?
Exactly. Carlos's experience is super common. These diagnostic checks in tax software often flag these kinds of misunderstandings.
So issue 1 for Carlos involved net rental real estate income. What happened there?
Okay, so Carlos initially put $35,000 in net rental income into other income on the main page of the Form 1065. He basically lumped it in with the ordinary business income.
And the problem is?
The problem is net rental real estate income is a separately stated item. It has its own specific line, line 2 on Schedule K and the corresponding K1s. It shouldn't be mixed into the ordinary income calculation on page 1
Why does that matter so much?
because rental income might be subject to different rules for the partner, like passive activity loss rules. Mixing it in messes up the calculation and potentially the partner's ability to use related deductions or losses correctly. It highlights why that ordinary versus separately stated distinction is so critical.
Okay, that makes sense. Avoids messing up other calculations down the line for the partner. Next, Carlos had a question about salaries versus guaranteed payments. We just talked about this.
We did, and Carlos ran right into it. He entered $50,000 as salaries and wages, which usually implies payments to employees instead of putting it on the line for guaranteed payments to partners. He also missed putting it on the partner's K1s initially.
So the fix.
He needs to double check. Was this really employee wages or was it guaranteed payments to partners? If it was guaranteed payments, he needs to move the amount to the right line on Form 1065 and report each partner's share on their respective K1.
Even though both are deductible for the partnership.
Right. Both reduce the partnership's ordinary income, but the guaranteed payments also have to be reported separately to the partner as their income, affecting their self-employment tax and other items. It's a classic classification error.
Easy mistake to make if you're not careful. And finally, issue 3, self-employment earnings and active participation.
Yeah, this is a big one for partners' individual taxes. Carlos left the self-employment earnings line blank on the K1s, even though his notes said both partners actively participate in the business.
And active participation triggers.
It generally means their share of the partnership's ordinary business income, plus any guaranteed payments they receive for services, should be included in their net earnings from self-employment.
Which means they owe self-employment tax on that amount.
Correct. Leaving it blank was wrong. He needed to calculate and report that amount on the K1s. Getting this right is absolutely vital for the partner's individual tax calculations. It directly impacts their tax bill.
These Carlos examples are gold. They really show why these seemingly small details matter so much. Okay, let's shift gears a bit to something called tax basis. Sounds technical, but the sources give us a good way to think about it. What is a partner's tax basis, and why should I, as a partner or potential partner, care?
You absolutely should care. Tax basis is fundamentally your investment account in the partnership for tax purposes. Think of it like that.
My tax investment account.
Exactly. The basic formula is your capital account, the money and property you put in, adjusted for income and losses, plus your share of the partnership's debts.
Okay, capital plus my share of debt. Why is that number so important?
Two main reasons. First, it limits the amount of partnership losses you can deduct on your personal return. You generally can't deduct losses that exceed your basis.
Ah, a loss limitation rule.
Yes. And second, it determines the gain or loss you'll recognize if you sell your partnership interest or if the partnership liquidates. It's the starting point for calculating that gain or loss.
So it's not static, it changes, right?
Constantly changing. Your basis increases with things like additional contributions you make, your share of partnership income, and gains, both ordinary and separately stated. Your share of any increase in partnership debt, and even your share of tax-exempt income the partnership might receive.
Okay, increases make sense. What about decreases?
Basis decreases by distributions you receive from the partnership, both cash and property, your share of partnership losses and deductions, again, both ordinary and separately stated,
Right.
your share of any decrease in partnership debt, and certain non-deductible partnership expenses.
Lots of moving parts.
There are. But here's a critical rule. Your tax basis cannot be reduced below zero. Distributions that would take you below zero might become taxable gain, and losses are suspended.
Okay, can't go below zero. Now, our source had that passkey comparing basis to a bank account. Can you unpack that analogy? It sounds helpful.
It really is.
Yeah.
Think of your basis like a running balance in a bank account.
Yeah.
When the partnership earns income, or your share of its debt goes up, it's like a deposit. Your basis increases. And generally, that income is taxable to you when earned by the partnership.
Got it. Deposits basis up.
Right. Now, when you receive a distribution from the partnership or your allocated share of losses or deductions, it's like a withdrawal. Your basis decreases.
Withdrawals equals basis down.
Exactly. And here's the key part of the analogy for distributions. Those withdrawals, the distributions are generally not taxable to you until they exceed your basis. They just reduce your account balance, your basis, down towards zero.
Ah, so distributions are tax-free up to my basis amount.
Generally, yes. They're considered a return of your investment first, Once your basis hits zero, further cash distributions usually become taxable capital gain.
That's a very helpful way to visualize it. Let's make it even more concrete with Rick Jones from the Acme example. Can you walk us through calculating his ending basis, focusing on how each piece impacts that bank account?
Sure. So Rick's a 50% partner. He initially contributed $50,000 cash.
Yeah.
Let's say his starting share of partnership debt was $10,000, 50% of $20K total debt.
Okay, so his starting balance, his initial basis, is $60,000.
Correct. $50 cash plus $10 debt share equals $60K initial basis. Now let's add the year one items.
Right.
Acme had $140,000 ordinary business income. Rick shares 50%, so plus $70,000 deposit to his basis.
Basis up to $130,000.
They had $8,000 dividend income. Rick's share is plus $4,000 deposit.
Price is $134,000.
Partnership debt increased by $5,000 total. Rick's share of that increase is plus $2,500 deposit.
Base is $136,500. Okay, those are the increases.
Now the decreases, the withdrawals. Rick received cash distributions of $18,000, so negative $18,000 withdrawal.
Base is down to $118,500.
He received a guaranteed payment of $15,000. Now remember, the $15K is taxable income to him separately, but the distribution of that cash still reduces his basis. So NAK $15,000 withdrawal. Correction. Guaranteed payments themselves don't directly reduce basis. The cash distribution associated might, but the payment itself is income. Let's assume the $18K distribution covered this. So we stick with the $18K distribution withdrawal. Okay, let's reevaluate that part based on the source logic. Wait, the example calculation does treat the cash distribution as a basis reduction. Let's stick to the example's flow for consistency. Cash distributions reduce basis. The guaranteed payment is taxable income separately. So the $18,000 cash distribution reduces basis.
Okay, so basis is $118,500 after the distribution withdrawal. What about the deductions?
Right. Acme had a $30,000 Section 179 deduction. Rick's share is 50%, so makes it $15,000 withdrawal from basis.
BAPE is $103,500.
And $16,000 in charitable contributions. Rick's share is $88,000 withdrawal.
Okay, final basis, $95,500.
Exactly. $95,500 is his ending year one tax basis. You see how every single one of those items, income, gain, loss, deduction, debt changes, distributions, adjusted his basis account balance.
That makes it crystal clear. Now, you mentioned basis limits losses. What happens if Rick's share of losses was, say, $100,000, but his basis was only $95,500?
Great question. That's the tax basis limitation in action. He could only deduct $95,500 of the loss in year one on his personal return.
And the remaining $4,500 loss, does it just vanish?
No, thankfully. That excess loss of $4,500 is suspended. It gets carried forward indefinitely to future years.
Okay, carried forward. How does he get to use it later?
He needs to reinstate or increase his basis in a future year. That can happen through any of those things that increase basis. More contributions, his share of future partnership income increases in his share of partnership debt. Once he has basis again, he can use the suspended losses up to the amount of his new basis.
So you need basis to deduct the loss either now or later.
Correct. But there's a critical catch. If a partner disposes of their entire partnership interest, sells it, or the partnership dissolves, any suspended losses due to lack of basis that haven't been used yet are lost forever.
Wow. Okay, so you don't want to sell your interest while you still have big suspended losses hanging out there if you can help it.
That's definitely a major planning consideration. And just a quick note, how much partnership debt a partner gets to include in their basis can get complicated depending on if they're a general partner, limited partner, or LLC member, and the type of debt involved.
Good point. More complexity there. Finally, let's quickly touch on limited liability companies, LLCs, super common structure. How do they fit into this whole tax picture?
Right. LLEs are everywhere. Legally, they're distinct entities providing limited liability to their owners called members. That's a key difference from, say, a general partnership where partners have unlimited liability.
So legal protection like a corporation.
Exactly. But the tax side is where they get flexible. The IRS tax code doesn't actually have a specific section just for LLCs.
Really? So how are they taxed?
They generally get to choose, or they fall into default categories based on the number of members. If an LLC has at least 2 members, its default tax treatment is as a partnership. It follows all the subchapter K rules we've been talking about today, flow-through income, K1s, basis calculations, the whole deal.
Okay, so a multi-member LLC is usually just like a partnership for tax.
Usually, yes. Though they can elect to be taxed as a C corporation if they want, by filing a specific form, Form 8832.
Interesting. What about single-member LLCs, just one owner?
Those are treated as a disregarded entity for federal income tax,
Disregarded, meaning?
meaning the IRS essentially ignores the LLC entity for tax purposes.
Mm.
If the single owner is an individual, the LLC's income and expenses are reported directly on the owner's Schedule C, just like a sole proprietorship.
So no separate partnership return?
Nope. And if the single owner is a corporation, the LLC's activities are just included in the corporation's tax return.
That flexibility is really powerful. Liability protection without necessarily locking into corporate taxes.
That's exactly why they're so popular. You often get the best of both worlds.
Wow, we really did cover a lot of ground today. From really understanding what flow-through means, seeing how ordinary income differs from separately stated items, to tracking that all-important tax basis with a bank account analogy. Our goal was that shortcut to being well-informed, and I really feel like we hit that.
Absolutely. We've tried to, demystify rules that can seem incredibly dense. Showing the why behind things like guaranteed payments or basis adjustments hopefully makes it stick. Whether you're already a partner, thinking about it, or just trying to understand business, these ideas are fundamental.
And hopefully you listening had a few aha moments. Thinking about this, connecting it to the bigger picture. And it makes me wonder, and maybe makes you wonder, how might really grasping these nuances, like how guaranteed payments work or how debt impacts your basis, change the way you look at joining a partnership or evaluating a business investment in the future?
That's the perfect takeaway question. Because applying this knowledge is where the real value lies. Keep digging, keep asking questions. There's always more to uncover.
Couldn't agree more. Thanks for joining us for this deep dive. Until next time, keep that curiosity alive.